I'm going to tell you how I lost 50% in the stock early in my career and what you can learn from my experience. Hi, my name is Gary Mishores. I'm the managing partner and chief investment officer of Silver Ring Value Partners. I also teach the value investing seminar at the FW Olin Graduate School of Business. So this was very early in my career. I was a young analyst at Fidelity Investments about 20 years ago, or a little, maybe 19 years ago. And I was assigned to an industry, the specialty chemical industry. That's how things worked. You basically were given an assignment to follow a narrow set of companies, and your job was to issue buy, sell, hold recommendations to the firm's portfolio managers. And there was a company there in my coverage by the name of PolyOne. The ticker was POL. And now I didn't look. I was straight out of college. I had just graduated from MIT, and I didn't know that much about investing. I just finished the level one of my CFA, so I knew a little bit of accounting. But Fidelity's approach was to kind of hire people they thought was smart and to kind of set them loose and let them reach their own conclusions. So here I was, and this company, statistically seemed pretty decent. This was circa 2002, and prior to the recession of 2001, 2002, they earned about $1 in earnings or so on a pro forma basis, which is kind of the first red flag. And I went out to see them, and there was a charismatic CEO. He went to Harvard Business School. He had a nice tie and suit, and was dressed the part, right? Because obviously, if how you dress clearly determines, how good of a manager or investor and so forth you're going to be. But anyway, that's an aside. So he had this strategy. So what PolyOne did was they made a whole variety of different plastic-related additives and polymers and so forth. And his theory was that they were going to buy or grow and have a plastic supermarket. They were going to sell to the same customers whole bunch of different things. Now, it sounds plausible. Like you go to a supermarket, or well, at least you did before the coronavirus crisis, but you probably went to a supermarket in your life, and it is convenient because if you're gonna buy sugar and salt, you don't want to go to different stores to buy your sugar and your salt. You buy them all there. So that was kind of the theory the CEO was putting out to me, and I thought, hey, that makes sense. So I went back to the office, I sat in my cube and pulled up my spreadsheets and started modeling away and typing and saying, well, they earned $1 and then they're going to grow at this rate and they're going to get the benefit of cross-selling these new products, so forth and so on. Maybe they can make a little bit more in $1, and that should be worth about 15 times earnings, and hey, it should be worth $20 or so. And the stock was at about 12. So I said, oh, we're buying something for 60 cents on a dollar. Great. My idea of value investing was very Ben Graham based. I want to buy statistically cheap stocks at the time. So, I made a recommendation that we buy the stock. We did. And basically, as to the stock, patiently waited for me to get on board, and then started falling slowly and slowly. And some of the portfolio managers started saying, "Hey, what's going on? How's it going? What's happening here?" And I said, "Oh, not to worry. We should be long-term value investors. We did our analysis. Let's just hold on." Now, for a while, they said, "Okay," and then and one of the portfolio managers who ran the value fund said, "Okay, let's call the company. Let's see what's going on." And we talked to them, and this was, already after regulation FD, so they couldn't just say, "Hey, we're going to miss the quarter." But every indication they gave us was that business wasn't that great, right? And the portfolio manager kind of looked at me after the call and said, "They're going to miss the quarter." I said, "You're probably right, but so what? We shouldn't be focused on quarters. We should be long-term, multi-year time horizon." Anyway, away I went, and then another portfolio manager stock kept falling. So I bought, I got the portfolio managers to buy the stock around 12, and the stock was going 9, 8. This is a big decline. 9 from 12 to 9 is 25%. And another portfolio manager said something is going on. Someone knows something that we don't. And I said, "Oh, probably people are worried about the weak quarter. It's not a big deal. We talked to them, and probably will be a little weak, but let's focus on the value. Let's focus on the business and this supermarket cross-selling strategy and so forth." And by the way, nowhere in there did I really think deeply about the quality of the business, kind of a Porter Five Forces analysis, think about the value chain, who the customers were, who the suppliers were, all of those type of things that now are second nature to me. But back then, look, I was 21. I was just learning. I mean, at least that's my excuse. That's not a good excuse. I should have tried harder. So I'm not trying to come up with excuses. I own my mistakes, but nonetheless, I didn't know to do those things back then. And then Christmas of right before Christmas of 2002, the company pre-announced results. And as you know, like this was literally December 23rd. You can look it up on the I remember it to this day. And almost nobody would ever pre-announce the week of the holiday week, right? It would be insane. Why would you pre-announce? Because you can just pre-announce in January or just wait for your quarter. Well, they pre-announced because they weren't missing by a little bit. Their demand was falling, through the floor, and they suspended their dividend, and the stock literally in that one day from already kind of the stock had already crept down to 6. Remember, I started at 12 here. We've been buying a little bit as the stock was going down, and now from 6, in one day went from 6 to 3. I literally wanted to throw up. I'm not saying this for to embellish or for effect. I literally felt nauseous. And at Fidelity, you had to go and kind of update the portfolio managers and analysts and tell them what to do next. That's the last thing I wanted to do. I wanted to crawl under my desk and cry because we had $100 million invested in this company, and the stock just collapsed, suspended dividend. I didn't know what was going to happen next. Obviously, my faith in my own analysis in the company and everything was shaken, right? I remember going around, one portfolio manager who wasn't particularly kind said, "You know what? I think you should go back home and reread what Warren Buffett wrote. I don't think you get it. Just take the rest of the day off." I actually finished my rounds, talked to everyone, finished my analysis of what to do next. Which incidentally, I'll give myself partial credit. At that point, the only way this company was worth as little as $3 per share was if they were going to go bankrupt. And I had the presence of mind to do the analysis, and it was extremely unlikely that they were going to go bankrupt. And we held on to the stock, and the stock eventually recovered, but it took some time. But I took the rest of that day off after I did all that work, and I did not feel very good. Let's say for the rest of that year, for the rest of the week. Anyway, the reason I'm telling the story is, now that I'm 20 years in, I've been mentoring a lot of young investors, and I've been teaching my seminar and just interacting with a lot of people. I see this a lot. Someone is excited about some story. This company is going to earn $1. Multiply this by some number, and you get the stock price, and voila. And I think I made a number of mistakes. So like if I were to think about mistakes that I would have you learn from, number one, I really didn't think deeply about the business. Is it a good business? What makes a good business? Who has more power? Them or their suppliers? Who has more power? Them or their customers? What are the barriers to entry? Is it easy to go and build this stuff? So I think that's a big mistake. Now, next, I think, decided to value the business not based on what they've done historically, but based on hopes and dreams. Yeah, so on a pro forma basis, in their peak year they made $1, and I was thinking growing that for a few years and assuming $1.25. But on average, they've never made $1. And this is a mature business. It's not like this is not the 70s. Plastics is not a growth industry at that point anymore. So if their average earnings were maybe 25, 30, 40 cents, I forget, but some low number. So that should have been kind of a red flag, is if the average earnings for a mature company, especially if the average cash flow, free cash flow for that over some economic cycle is pretty low, then how realistic are your hopes for a very different future? That's the second mistake. And I would say the third mistake I made is listening to kind of a management story and believing it, kind of hook, line, and sinker, swallowing that whole thing. Because I didn't talk to any customers. Sure, it made sense that customers might want to buy multiple things from the same provider. But what if these guys weren't the best in each of those things? Maybe let's say they were really good at product A and B, but not as good in C, D, and E. Would a big client care about buying in one place? They have buyers, they have a big organization. Why not buy from the best of breed? Buy A and B from them, and C, D, and E from whoever is best or has the best combination of price and quality at C, D, and E. So I didn't really vet that thesis. I kind of took management's word for it. So those were the three mistakes. I hope you would learn from my experience, and I hope this story, which is, It's funny now, 20 years later, but I can assure you it was not funny or fun at the time. I hope it'll save you from some mistakes you might make in your own investing life and practice. If this video has been helpful to you, please hit like and subscribe to my YouTube channel. Thank you, guys.